Here are 5 tips to help you prepare for the next bull run. 1. Create an investment plan. Cryptocurrency is known for its volatility and unpredictability. Avoid the temptation to jump in head first at the sign of a rally with all of your funds. First, sit down and create an investment plan or thesis to help you decide where to allocate your funds. Think about how much you're willing to put into blue chips, like Bitcoin and Ethereum, and how much into altcoins. For altcoins, consider which industries you think have potential and consider dividing up your portfolio between them. For instance, 20% to AI, 30% to real-world assets, 10% to layer 2s, etc. Then consider dollar cost averaging into your position in order to take advantage of any dips. 2. Set profit targets and stick to them. One of the biggest mistakes in investing is not knowing when to take profits. This is especially true for cryptocurrency, where the market is driven by emotion, social media, overnight sensations, and let's face it, greed. As prices surge, set realistic targets for taking profits and stick to them. A disciplined approach to profit-taking can protect you from sudden market downturns. If you're unsure of where you want to exit, then consider scaling out by using a dollar-cost averaging strategy to sell. For instance, sell 25% of an altcoin at price point 1, another 25% at price point 2, etc. 3. Diversify your risk. While Bitcoin and Ethereum are considered blue-chip cryptocurrencies, many investors look to altcoins for higher risk-reward assets. Given the higher risk of altcoins, you should consider restricting them to a small portion of your portfolio. The opportunity for reward is higher, so you still have the potential for reasonable gains without over-allocating and exposing yourself to excessive downside. But keep in mind that any gains can be short-lived, and many altcoins are not suitable for long-term buy-and-hold portfolios. Most altcoins falling out of favor between market cycles and downturns of 95% plus are common. That means it's important to have a clear exit strategy with a target price that you set before you enter the trade. So if you are considering a portfolio that includes altcoins, make sure to balance your portfolio with a mix of high-cap cryptocurrencies and altcoins to mitigate volatility. 4. Research-based decision-making. Avoid investing based on hype or FOMO. Cryptocurrency is a unique asset class because every transaction is recorded on the chain for the public to see. This means you have ample tools and information available to you to help make educated decisions instead of having to sift through the tea leaves like in many other markets. Here are a few free tools you can add to your kit. AI. Put in any address to get an analytical breakdown of its portfolio, transactions, and more. Get an overview of in-depth data for individual blockchains, dApps, layer 2s, and DeFi with metrics like total value locked and trade volume. Fi. Like an antivirus scanner for cryptocurrency and smart contracts, intended to detect intentional rug pulls and malicious or flawed smart contract code. Arkham Intelligence. Arkham is a blockchain visualizer that lets you see the relationship between wallets in an easily understandable way. You can use it to flag suspicious transfers or prevent a Sybil mistake when airdrop farming. CryptoFundraising.info. This tool tracks VC funding for new crypto projects, giving you an insight into the amount raised and from which firms. Use these tools to conduct thorough research into a project's fundamentals, team, and market position. You can do this by conducting a SWOT analysis, which will help you identify strengths and weaknesses within a project. 5. Risk management. Risk management is the first strategy every new trader needs to learn, but is often overlooked until it's too late. Manage your risk effectively by calculating how much you can afford to risk on your overall investment and then stick to it. Follow this up by calculating how much you can afford to lose on any given trade and then stick to it by using a stop-loss order to limit your losses when the market moves against you. Support these strategies by avoiding emotional decision-making and creating an investment plan that includes target entry and exit prices. Thank you so much for watching. I hope you enjoyed this video as much as I enjoyed making it. If you found value in what you saw, don't forget to give it a thumbs up and leave a comment below, sharing your thoughts or suggestions for future content. Remember to hit that subscribe button and turn on notifications so you never miss out on any of our latest uploads. Your support means the world to me, and I can't wait to see you in the next video. Until then, take care and stay awesome.